This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. My guest today is Kathy Kristof. Kathy is a contributing editor for Kiplinger Personal Finance magazine. She has worked in financial media for quite a while, so some very good experience in that area. So I wanted to have her on today because she's talking value, and obviously I come from a trend or a momentum style thinking. And we have a nice conversation, and I have a feeling we have a lot in common from a public policy and an economic standpoint. At the end of our conversation, it really changes more towards technology arbing away the need for human beings. But most of our conversation is me giving some slight pushback to the value perspective in current day markets. I do want to add a few notes before I let our interview play. Kathy brings up the phrase manic depressive market. And I'm not bringing these points up as a way to continue a debate when she can't respond, but I just want to add some thoughts here for you, the listener, to think of as you listen to our conversation. She brings up the idea of a manic depressive market. She talks about spotting underlying value and mentions today that valuations are not so out of touch. Now, one pushback that I would give there, which I did not give in our interview, is there are quite a few analysts out there, fundamental analysts, that would say valuations are out of touch, like John Hussman, for example. Kathy brings up PEs not being out of whack right now. Once again, John Hussman, a fundamental analyst, is saying they are out of whack. I think also she brings up the idea of relative value, in the sense that if people can receive no return from saving money, then they're going to put it into the assets that the Fed is goosing. You know, also we talk about inflation, and she brings up the idea of inflation debates and that there's not really any indication of inflation today. The reason I wanted to have this conversation is that it is very different from my world. And like I said, I do give some pushback in the interview, and I do challenge her. But I like Kathy, and we had a fine conversation, and I think it's useful that if an investor, a trader, doesn't really have a strategy yet, is still on the fence as to why trend trading might be a strategy, momentum trading might be a strategy that works, fundamental perspectives, value perspectives. I just think this is a nice conversation for drawing a line in the sand. And what I love about my world, like I said, I don't pick on Kathy too much in our conversation, but what I love about in my world is you don't have to know all of the things that we talk about, which I would argue that you ultimately can't know. You can't know when inflation is going to shift. You can't know when the black swan is going to hit. You can't know when the Fed is going to do something. But you have to have a strategy that can adapt to changes. One other slight disagreement that I would have for Kathy, and hopefully when I have her on again, I can discuss this, was she brought up the idea of the market, U.S. stock markets, for example, having dropped 50% twice in the last 13 years. And she made the case that, well, if you just didn't panic, the market came back relatively quickly. I don't like that type of thinking or strategy because I would point to other examples like Japanese stocks, for example, which hit all-time highs in 1989. So even though U.S. equities have had two 50% drops in the last 13 years, I think everybody, including Kathy, would not be surprised at another 50% drop And who knows? It could be like the NASDAQ collapsing in 2000, which was a 77% drop. And who's to say the next time that we have one of these 50% drops or 77% drops, who's to say those markets, those equity markets, don't stay down for 25 years plus, like Japanese stocks have? All good food for thought. I hope you enjoyed this conversation. I really enjoyed having Kathy on, and hopefully I will have her on again. And as I say at the end, when some really crazy stuff happens, we'll get on and banter and barb each other a little bit. Enjoy. Let me jump right in, because we were originally going to have this conversation to kind of look back and say, what have we all seen in the last 5 years since the fall of 2008? And there was a Kiplinger piece talking about bubbles, and that bubbles happen fairly often. And with that backdrop, what do you think?
You mean whether we're in a bubble now?
No, not even that. No. Like literally, just if we have bubbles, and we know we're going to keep having bubbles.
Mm-hmm.
What does the average investor do?
The average investor actually has to pay attention to the numbers and not drink the Kool-Aid. The real problem is that the market is manic depressive, and it's been manic depressive since time began. You can read Benjamin Graham from God knows when, talking about how the market has a tendency to swing from, the depths of despair to mania. And it's always done that. But you as an investor, if you pay attention to the underlying value of your portfolio, you don't have to swing from, way high to way low. You can look at things and say, you know what? This is overvalued. I remember literally when I was writing my first book, or actually it was my third book, Investing 101, in 1999. And I could not find stocks that made sense to buy because they were all crazy expensive by every, reasonable measure of valuation. And so in 1999, I'm out there telling people, you've had a really good run. You might want to switch into bonds or something. You don't need to be in stocks right now. And people thought I was nuts, but it was really because the underlying values weren't there. We used to have conversations in the Times newsroom about what will happen. We were all kind of anticipating that the market was going to crash. And discussion was, what if the market crashes 1,000 points this time? And I said, you know what? I think what would be really bad is if we have a really long period of no or low returns. And that's actually what happened. And the reason why that was worse than a crash was because people had gotten into this concept of, if the market drops, it's a buying opportunity. And then, now people are in the mindset still that if the market drops, it's probably the beginning of a really bad thing. But if you look at market valuations right now, they're not out of, touch with reality. I mean, a few hot stocks are, but the overall market isn't really out of tune with, what's going on with the economy, what's going on with earnings. There's still a lot of good things to be said about, corporate balance sheets. And so I think with the exception of some hot stocks that everybody wants to buy, that are well past where they ought to be, the market's in okay shape.
Let me give some pushback for you to respond to. So if we look at the last 13, 14 years, we've seen the S&P take 2 minus 50% hits. I don't think there's anybody listening right now that could not reasonably look in the mirror and say, you know what? I guess we could take another 50% hit at some stage of the game. So if you hold that thought to the side for a second, and then I think for the average person to look at a situation and say, when have stocks got in really high? And there seems to be there seems to be a correlation with what the Fed does with interest rates. And so I guess for me, it seems very, and like I said, this is the pushback I'll let you respond to. How does the average person decipher that? Because if the S&P was to take another 50% hit from here, we're really retracing back, almost 15, 16 years. And so then it seems very difficult to try and figure out value today.
Yeah, you know what? If you're trying to figure out value based on a market index, it is incomprehensible. If you try and figure out value based on price earnings ratios and dividend yields, then it's not so confounding. Then you can actually see why the market is where the market is and why you have crashes. They relate to earnings. We as investors are buying is essentially a future earnings stream of a company. And so that is not as unpredictable as just a market index. Now, interest rates do have a very real impact on investors and on stock prices, on bond prices, on all of investment securities. And the reason why, again, is very logical. And it's just that every day you have cash that you can bring into the market, or you can move from one investment to the other. And so a reasonable person is going to be taking a look not only at the value, but at the relative value. So if I can get more on a fixed income, a safe fixed income security tomorrow than I do today, that's going to look comparatively more valuable. And so every time interest rates ratchet up another percentage point or even half percentage point, that's going to look a little bit more attractive to me. And at some point, particularly, depending on my circumstances, I'm going to start shifting assets over. And the same in reverse, right? Years and years ago, I am going to betray my age here. Treasury bills were yielding, 14, 15. I think they even got up to 21%. And that seems
crazy. Almost mythological, right? It's like, did that really happen?
Yeah, it just seems impossible, right? But by the same token, if you can get 20% or even 14% on a government security, you are nuts to invest in stocks instead. This is better than the historic average of stocks, and at least theoretically, no risk except for inflation risk, right? And so now all of a sudden, the pendulum swings, and so right now, the market is definitely, or the interest rate scenario is still definitely in the favor of stocks. And I also think there's a compelling argument that corporate balance sheets continue to be extremely clean, and that bodes well for the future. So even though stocks have really risen a lot since 2008, and in a normal circumstance, you'd go, oh my gosh, that's, it's a warning sign. I don't see it as a sign that we're going to have a crash anytime soon. Although I have to say, I think the market is incredibly nervous because of our past 10 years.
How do you define nervous? What do you, when you say that, what do you mean?
You know what? I first started reporting about stocks in the 1980s, and that was right after the miserable decade of the 1970s. And so whenever stocks wanted to rise, you'd have a day where, earnings would come out and everybody would go, oh my gosh, that was great. That was much better than we expected. Stocks would go way up. The next day, some little thing would happen and stocks would go way down. And so you had this really volatile stretch. And I think that's what you're seeing now, is you're seeing you're seeing a market or you're seeing an economy that's improving. And so people are cautiously optimistic. But every time something surprises them on the downside, they're going, oh my gosh, it's an omen, and skittish and selling out, to avoid the big loss that you're talking about. The reality is if your time horizon is such that you can't afford a substantial loss in the stock portion of your portfolio, you should not have that much money in stocks. You need to put your long-term money, really long-term money, into the stock market and keep the money that you need in the next 5 years, say, in something that's a little bit more stable, even if it doesn't return you that much.
Kathy, to the person out there, since you've got plenty of perspective and experience, and I know you enjoy the pushback as a chance to make the case. So to the person that's sitting out there and is saying, well, Kathy, this sounds great, and we can, the numbers, quote, don't lie. We can all see that U.S. stocks are at nearly all-time highs, if not today. It seems to be changing here by the day on the upside, but the people that have memories and they say, wow, this idea of interest rates at zero and Federal Reserve policies that I don't quite understand, that seem all designed to just make asset prices, stocks and or real estate, go up. And I isn't that a part of the nervousness that people don't really know what's real? That when you have so much government intervention that you start to kind of, isn't it reasonable for some people to say, well, I just don't trust because I don't know what's real? Is that a reasonable perspective?
It is. The thing that I worry about long term with current Fed policies is that I think that they are long term inflationary, and inflation is really a tax that you can't get around, and so it's and inflation affects people and investments in so many different ways that it's really hard to find a way around being negatively impacted if and when inflation strikes. Now, so that to me is a very reasonable worry. There is no hint of inflation right now. And part of that is because of what the Fed is trying to combat. And I think at this point, poorly. The Fed is trying to get people working. And we have had some really significant changes in our job market. And I think that they're going to take a while to work through. And for us as investors, we're actually kind of better off with a softer job market and a slower recovery. It actually allows people and companies to put their houses in order and be much healthier on a long-term basis going forward. One of the reasons why we have this horrible crash in 2008 is because we were like, a crazy family who just decides to spend, more than their income on their credit cards for decades at a time. And we walk into the 2008 and the economy wasn't quite as strong as it needed to be to support our overspending. We'd spent, not only next year's raise, but the, 5 years hence raise. And all of a sudden people went, oh, and they couldn't do it anymore. And so then you see a huge backlash, economic backlash. We've been doing the opposite since 2008. As individuals, government, unfortunately, is the crazy credit card spender at the moment. the government spending does worry me on a long-term basis. And one of the reasons why is because it's one thing when consumers run short of cash. It's another thing when government can't do anything about it, when the government is tapped out and no longer can step in and do what it's been doing in the last few years. When that happens, I don't know, but certainly I think we're a lot closer to that point than we were 5 years ago. And that is disturbing. But for the moment, we have kind of the Goldilocks economy. We have a slow growing economy that is based on people spending reasonable amounts given their income and assets. And that is, if that continues, we're in very good shape. We're in very good shape for a while.
Let me throw it to you another little pushback. So the idea of a potential black swan, the unexpected surprise that can knock the Goldilocks economy off, because I've looked back at some of the language from the Fed in the 05, 06, 07 time period, and literally it's like we see nothing on the horizon. Real estate looks great. I'm paraphrasing, and they were very wrong. And so once again, I think this conversation is useful for people to listen into, because it's just to get people thinking that yes, you can take certain steps, but there's no guarantees.
Oh, there are never guarantees. You know what? There are no guarantees in life. You can be the healthiest person in the world and, get hit by a bus tomorrow too. But I think that you have to look at what's reasonable and understand that, black swans do happen. And I have to tell you, whomever was saying, yeah, nothing was on the horizon. I was not talking to those people because in 2007 and 2008, I think I said it in the business editorial meetings at the LA Times, we were talking a lot about unsustainable spending and debt levels at record highs, and just what was going to happen when this hit the fan. And so I think that there were a lot of warning signs there. The thing that I think surprised everybody about 2008 is that there was no safe haven. No matter whether you were in stocks or you were bonds, you were international, no matter where you were going to get hit. That stinks, but it also is just something that investors, have to recognize is one of the risks of the game. That your alternative is to put all of your money in bank accounts, and that's not going to allow you to keep up with the rate of inflation. So I don't think that's a good alternative. And I also think that we pander to people by dealing with their fear of the 50% loss. But that 50% loss was temporary. And if you didn't lose your head, you've gained it all back, and then quite a bit. So it's really a matter of, as an investor, controlling your own head, understanding what you're invested in and why, and then making the reasonable choice of, is this real, or is this, a momentary depression of a manic depressive market? And I think that individuals, if they step away from all of the frantic talk in Wall Street, are likely to make very good decisions.
Let me ask one last question for you today. I appreciate you taking the time. So I want to give a comparison or just an idea and let you express your thoughts. So you're mapping out a value-based scenario in our conversation today. I can think of an investor in LA. He's a hedge fund guy, and I'm not bringing him up to promote hedge funds or to have a comparison talk about whether individuals should invest in hedge funds, more for his strategy. And his name is Mark Spitznagel, and his strategy is really about finding black swans. And his strategy is really almost the antithesis of value. It's like, I'm going to take many little bites at the market looking for that home run trend. And then there's other traders out there also that might take an approach where they say, I'm just going to ignore value. I'm going to ignore fundamentals, and I'm going to try to ride trends up and down. Like I said, not to try and make a comparison to hedge funds, but to individual investors. I'm curious what you have talked to people over the years and what you've said when individual investors maybe give a little bit of pushback and they say, hey, Kathy, here, I know you're laying out the value scenario, but here's some other scenarios that seem to have some results. What is your feedback on something like that?
Almost every strategy, at least at some point in time, will have good results. The thing for investors to do is follow a strategy that they understand and that they can stick with. If you understand, I know people who invest with momentum. And to me, it seems like investing by a greater fool theory is, as long as everybody's jumping in, you just have to be quicker than they are jumping out. I can't invest that way because it's too frantic. I have to invest based on a value strategy because it's what I understand. It's what I can stick with. It's what allows me to ignore the manic depressive swings of the market. And every investor needs to find their own strategy. Are there strategies that are completely different and that I would find insane that other people use effectively? Absolutely. And if you have one, more power to you. And this is mine. I'm not trying to recruit. I make no more money if you decide to be a value investor than if you decide to be a momentum investor. It's completely up to you. I like to tell people I'm one of the few people who are going to give you advice in the market who has absolutely nothing to gain. If you decide to buy my book, I think I make like 10 cents a copy. So, that is not a head turning amount of money for me at this stage in my life, I'm happy to say. So it's just, you take the strategy that you get, that you understand well enough to not panic when everybody else around you is. And whatever that strategy is, go to it. But again, the biggest thing you have to do as an investor is learn how to be calm when everybody around you is not.
Well, you've calmed me down tonight. I'm very calm right now. Yeah, you're very calm.
I hope that's not because you're bored.
No, you're very calm. Hey, listen, one quick thing though, too. You did mention, this isn't even related really to investing, but it's very important to individual investors and just individuals across America. You mentioned the idea of the Fed trying to target unemployment, and I'm curious in your conversations in your circles. I look at it, it seems very difficult thing to do because the one thing when the Fed says, hey, we're going to target unemployment, that assumes that there's nothing going on in the real world that has dramatically changed. And to me, when I look at technology is just arbing away the need for human capital at a breathtaking rate. And so I wonder somewhat about this idea that maybe we're trying to target something where the sands have shifted so dramatically. And I mean, do we ever really get back to some of these ratios and percentages that the government wants to target?
That's a good question. I agree with you in that technology has created a vast shift in the labor market, and it's created a huge rise in entrepreneurial pursuits. So, in my circle of friends, a tremendous number of us are independent contractors working for ourselves, working at home. We're not in that traditional labor market that gets on the freeway every morning and clocks in at a company. And yet we're doing fine. And in fact, better than fine. And that is a consequence of a technological revolution that it has incredible impact, and it's been going on. It's been going on actually all of my career, and probably will continue for generations to come.
I'm calling you from Southeast Asia. So that's a pretty good example, right?
Are you really?
Yes.
Where are you in Southeast Asia?
I'm in Saigon right now.
Really?
Yes.
Oh, how fun is that? You gotta love it.
Good pho.
Pardon me?
I said good pho.
Good pho?
Yeah.
There you go. Yeah. Well, that is exactly, you can do your job from any place in the world. Technology has made it possible to make phone calls, not just across countries and time zones, but cheaply across countries and time zones. And to, it's an amazing thing. So yeah, the world has changed. How the Fed does this with employment is an interesting thing. I mean, they're pulling all of the traditional levers. And the traditional levers essentially have to do with trying to boost the housing market, because housing has such a
wealth effect.
There's just one. You buy a new house, then you have to get a refrigerator and a washing machine and a sofa, and all of a sudden it spurs a whole manufacturing machine into motion. And so that is traditionally what you do. Now, is it going to work this time? Heck if I know. Greater minds than mine have been really, really wrong in the past. And so
and I think a lot of the new jobs too have been part-time jobs and maybe lower salary service jobs. And I just think it's a conversation. I mean, look, the conversation we're having about investing is very important. I might even argue the conversation about what really amounts to finding your passion, finding your love, finding your work, finding your entrepreneurial venture. That might be the most important conversation that America's not having.
Yeah, you know what? I mean, I think if people are having that conversation, and the noise of the market can sometimes drown out the noise of Main Street. But I do think that upcoming generations, the young generations, are very much talking about finding work that they love and that they want to pursue and that they find significant. And I think that's a great thing. And I actually am very optimistic for this generation and future generations, because I think that we have broken the bounds with technology of traditional work and made work something that you can, mesh with your family, mesh with your travel, mesh with your life. And that's really a wonderful thing. So I think that for your lifestyle, things can be very good, and that you should always remember your investments just support that lifestyle. Yeah. Being rich means nothing unless you're living well.
There you go. Hey, listen, Kathy, it was a pleasure having you on today. Where's the best place that people could reach out if they want to connect with you, follow your work, reach out to you on Twitter? What's the best place for people to go?
Well, I'm on Twitter. I'm on Facebook. I write for Kiplinger Personal Finance Magazine. You can reach me there. You can reach me at CBS MoneyWatch. I also write for Financial Planning Magazine. I'm all the heck over the place. You can just find me anywhere. So any of those will work. Okay.
Listen, I appreciate it. And hopefully when we have something crazy dramatic happen, we will chat again.
Okay.
We need something. We need an explosion of some sort, metaphorically, not figuratively.
Yeah, please. Yeah. Please make it metaphorical.
Okay.
All right.
Okay. Take care.
All right. You too. Bye-bye.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash, or just trying to make a lot of money. Trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.